versus dividend stocks slash ETFs in this video. I know we kind of chatted about this maybe in a previous video, but I want to kind of deep dive in comparing, contrasting these two. And I don't know, for me, I'm not gonna say I'm struggling with deciding what to buy, but I think right now, for me, both of these asset classes are good from an investment point of view. So I think just kind of laying it out on paper would help me, and I guess anybody else, help maybe decide what would be, I guess, the optimal place to put some cash. I don't remember which pen I used previously. We do have a fine tip pen. I like this a lot, but I think for video purposes, a little bit thicker pen works better. So we used the 7 pen. I do like the very fine tip pen, so we're going to be talking about, let's do bonds. It's a little small, so we'll zoom in a little bit. Bonds versus we'll do ETFs because I think it's a little bit better comparison or contrast, to compare and contrast. So I guess I want to just put some things on so we don't forget. We gotta talk about risk, inflation. I'm just gonna chicken scratch this. Risk, inflation, yield, return, appreciation. What else? That's probably it. So, bonds. Let's go over here. Bonds. Let's do bonds first. So, bonds are different than, let's say, buying a dividend ETF, obviously, because one is you're buying debt. Buying debt. And in return, when we're comparing, so when we talk about bonds, let's only talk about, how do we want to do this? Because we could talk about junk bonds and higher yielding bonds that have, more risk. I think to keep it more simplistic, we're going to be focusing on, let's do T-bonds, T-bills, whatever, and like A to like AAA bonds. So we're talking about very, very risk adverse bonds. I think that's be a good comparison. Because again, we can talk about bonds that are yielding higher returns or higher yield, but it's more risky, obviously. That might be a topic for another video, but I don't really have experience buying those. If I'm buying a bond, I want like 99% certainty that money will get returned to me. So buying debt, there's often like a holding period. Usually you're gonna hold it till it matures. Let's say, I'm not gonna, most of the bonds I've been buying have been the 3-month bills. Right now the T-bills for the US government's yielding 5.4%. So pretty nice, but yeah, you typically, 3 to like 10-year bonds, probably people buy. I don't really hear people buying 30-year bonds that much, but I mean, if you can get the yield for it, like if you're getting like 8% yield or something, yeah, why would you not? But buying debt, there's a holding period. I'm just gonna jot stuff down. There's no appreciation. Let's go to ETFs. My mind keeps wanting to think about ETFs. You're buying, let's say, basket of companies. There is appreciation and depreciation. That's one thing people I think always fail to mention in like videos and when they're chatting with friends and stuff, like, oh, the market is always going to yield like 7% a year or whatever on average. But again, just because you take the last like 30 years and you say, okay, it's about 30% return, it doesn't mean the next 30 years it's going to return 7% annually on average. Again, I think the probability of that is less or like lower, but again, like Japan's the example everyone brings up. Like they had, I think, a pretty good economy. In the last like 30 years, their stock market and economy has been like flatlined. So there's always that consideration, but there's always a depreciation, and there will be periods of time. Like if this is time and this is price of the market, you can see that time and price of the market. Like you're going again, you're gonna have these troughs or these lower points of time, and that's the depreciation. So if again I'm not gonna say you have to hold in those periods, but selling in those typically isn't the best, but it's oftentimes like you don't even know you're in those periods. But yeah, anyway, there's depreciation just as much as there is appreciation. What else there is? It's more, I'm gonna say more liquid, but you can, there's no time period I guess you have to hold. I'm gonna say not locked into holding, although again if you're buying a dividend ETF you might want to hold it. If you're buying a normal ETF, maybe you don't. Zoom in a little bit more. Risk, so inflation is, no matter what we talk about bonds, ETFs, high yield savings, just cash, gold, silver, it doesn't matter what we talk about, inflation will be affecting all those at the same time. So to me, I'm not gonna say we should ignore it, but I think if you apply the inflation number to every like assets, or if we're talking about bonds or ETFs, and we apply, let's say, 4% inflation a year, well, it doesn't really matter in a sense, because like again, let's say you're getting 3% on a bond and inflation's 4%, technically you're losing 1% a year. But if you buy a dividend ETF, you're yielding 3%, and again, inflation's 4%, you're still losing 1% a year. But the thing is with the ETFs is there is potential for the appreciation, but again also depreciation. But the more attractive thing, if there is inflation, is that the appreciation would hopefully give you a higher return with the dividend, that it would overshoot inflation. So again, if appreciation, let's say you're predicting 3% in appreciation with this ETF with the 3% dividend yield, on average every year, let's say you get 6%, then also okay, it's better if inflation's 4% when comparing it to a bond. But for the purpose of, in my portfolio and opinion, of a dividend ETF specifically, is for the cash flow of the companies generating the income to give you dividends. So if there is appreciation, nice. But I don't want to necessarily factor that into my equation, because that is uncertain. Because if I factor in appreciation, I should probably factor in depreciation. But for the purpose of just this conversation, we'll say that better, potentially more gains with inflation. Okay, yeah, so this fluctuates. Market, like actually stocks fluctuate you're getting your principal back, especially with the T-bond or these AAAs, even like the probability you're getting your money back is quite high. Again, there's always a risk, but it's quite high. So you're getting back your principal along with all the interest from the yield with those payments, with almost certainty. So, when the market is depreciating, the bond that you own at least is staying quite stagnant. Is there anything else? Return, yield. Okay, so now keeping this stuff in mind. Is there anything else I want to talk about though before we move on? The biggest thing about these for me, what to buy. So right now, as of recording of this video, it's the end of August. End of August. We got T-bills. We'll do, they're looking at 1 year's 3.4, 6 months are 5.48, 3 months 5.44. So it's like, why would we not just do the 4? We can get this yield right now on a T-bill. That's like 99.9% guaranteed. I would say almost 100, but I don't like saying 100. Let's do end of August. We can do CHD, which is my preferred ETF right now. We got 3.54%. Let's do these as a comparison because this is what I'm currently thinking about. Again, not a recommendation, but just what I'm thinking about. 6 month. I'll do half year T-bills. That looks good on my end, but not on the camera. Half year T-bills versus SCHD. How do I decide which to buy? Because to me these look pretty good. Now obviously if you're looking at the yield, you're like, oh, definitely the T-bill. But again, this is 6 months, so when the 6 month ends, I am getting, my 2 payments, or, if you had $100,000 or $10,000 in this, well, technically you're not getting the full, technically 5.5%, because you're only holding for the 6 months, and this yield is based on a year. So on that $10,000, you're not getting $548. You're getting, what is it, like 280? I don't even know. Like, it's more than 250, 260, 270, 274. Is that right? Why can I do math right now? 5. So you would get 5 on 274. So on $10,000. If you held for 6 months, you would get $274. Sweet. But another thing about that too is the taxes. Taxes are big. Taxes. That's a big thing too. But anyway, let's just say taxes. There's no taxes. It's a great world. That looks better than like in a year if you already get like $354. But the thing to keep in mind is, yeah, at the end of 6 months, this it only lasts 6 months. Still owns at 6 months. But if the market goes down, this yield goes potentially up. And yeah, there's so many things to discuss with this. It seems so simple, but it's not. Okay, we'll take it once. Baby steps, baby steps. T-bill. 6 months. At the end of 6 months, you will have your extra like $270. At the end of the 6 months, you'll have your like 354 divided by 2, whatever that is. Sweet. You still get some money. Obviously, in any portfolio, the best thing to do is obviously to have both of these. But we're debating I want to debate what is optimal and kind of compare it and understand the differences in the strengths of buying actually, I can get it. Let me do some clicking over here. Like the beta, I guess we can. I'm gonna say this. It doesn't even matter if we have this information. The beta, the 5-year monthly beta. The 5-year monthly beta is 0.81. So that is not. It's not. I wouldn't say it's that not volatile, but that's not that volatile. Obviously, a 1 is the market, so this is moves less than the market. Again, the beta of a T-bill is like 0. It does not move with the market. It just is its own separate entity. So, obviously, this dividend also does it fluctuates, and hopefully over time, again, it goes upward like that slowly. But it's gonna fluctuate because they have to buy and sell different assets. So this is the next question. If we knew if this T-bill was, let's say, 5 years on 5.5%, that's different because that means for the next 5 years we can get each year 5.5%. So now when we compare it to, let's say, this, all of a sudden this doesn't look as attractive because in 5 years this might slowly climb to like 4.25% dividend. Maybe you get some appreciation here and there, but the financial the amount of money you could have made, the opportunity cost potentially could have been so much better here. And again, the risk is, I would say, about 0% risk. Like, again, there's some, but it's basically 0%. So it's like, why would I put money yielding a little bit less with some potential appreciation or depreciation? And after 5 years, maybe not generate as much cash flow. And again, it depends on your financial goals. It depends on the individual. But again, I'm speaking kind of for myself. It's like, if this said 5 years, I think it's a no-brainer. I would just, shove everything in there. But right now, the 5 years are yielding 4.47% in their notes, 5-year notes. So it's like, okay, well, I can get 4.5 here, which is still kind of good, right? But if I look over here, I can get 3.5, a percentage point less. Own an actual asset. We get to actually own the asset. But again, it's like, how do you know if it's a good value or not? That's the thing too. It's like, I would just, how these ETFs are structured. Again, that they're a basket of a bunch of stocks. So if the whole market's going down, and those stocks are going down, maybe some cut dividend. Like if things get really bad, they cut dividends, XYZ, all this stuff. But even during COVID, if I check this really quick, they've been growing their dividends since 2013. 11%, 15, 9, 9, 7, 7, 20, 17% during COVID, 10, 13. Like they're. So let's do this. Div growth is about. Let's be. It says CAGR to 2022. It's about 14%. Let's say 10% growth each year. Each year, this dividend's growing 10%. So right now, it's 2.56. That's that right? It's 2.6. So right now, as of today, it's $2.60. So in a year from now, we can expect this to grow 26 cents. Is that right? Am I being dumb here? Move the decimal over. Add. So $2.86. Which, I mean, if I buy it at today's price, let's see, today's price is 73. $2.86 divided by 73, which would be a 3.92% yield. Now that's buying it for the forward yield, which I mean, it could be lower, it could be higher, but it's just, it's not. I don't like doing that. I just feel like that's not cheating, but I think it's cheating yourself in a sense. But 10% growth, let's say, on that dividend. So there has to be a wide enough margin between all of these, where if the margin over here is just so much higher than here, it's like, okay, I'll just, my 0% risk, get my yield and call it a day. But like right now is why I'm struggling, is because I see these two, and in my head, if I do all the mental math, they're almost equal. I guess from it's also like time perspective. Like if I say in a year from now, if I say in a year, I think they're about equal. Maybe not. Maybe in a year this is better. If I say 5 years, it's like, okay, this is looking better. Obviously, because I might not be able to get this return in 5 years, right? But I can get this return in 5 years, or in the next 5 years. You know what I'm saying? But where's I going with this? I think they're right now quite equal, and I think if they're equal, it almost makes more sense to buy the asset, especially with how relatively young I am, because we got a long time. Hopefully, again, this gets some appreciation, but hopefully the dividend growth, even if it's like 5%, that's still massive compared to buying a yield like this, where again in 5 years when these things mature, I'm out of luck. Like, so okay, a good example. Let's just do this. Let's start writing stuff. Let's say I put money here. I got that. So cool. And let's say I put the same amount of money, and I add this. So we got 5 years with the 5, and I don't add any money, and we got that amount of yield in this ETF. At the end of the 5 years, I'm left with potentially more money from the cash flow here with 0 risk, essentially 0 again. But I have to find another vehicle to put this money in, which it might even be this, which might be good if this was lower than it was at the time. You know what I'm saying? But if I do this, buy the same amount of money into this asset at this time, well, this is still growing 10%, let's say year on year, with some percentage of, let's say like 2% appreciation. I don't even care, it doesn't matter too much to me. Appreciation, that is a terrible handwriting. 10% does seem like a lot though. Oh man, how do you grow the dividend 10% a year? That just seems like they've been doing it the last 10 years though. I would rather own this at the end of the 5 years, because actually I don't want to do we want to do that quick math? Let's see, let's do that quick mental math. 2.6, then we got 1, we got 2, 3, 4, 5, then we got 2.86, then we got 28. I don't want to do that mental math. Do I even have Excel open? I do not. 2.86 times, wait, no, I want to do 0.286 plus 2.86 that we're looking at. I didn't do something right, that is way too high. Okay, anyway, I'm not trying to waste anybody's time. Anyway, this will be higher. Maybe it's definitely above 3, maybe it's like 3.5. So on my original 3.5, on like, let's say $73 is it right now, I think my average cost is like 70 though, but let's just say 73. Let's say in 5 years it's yielding $3.50 per share. Divide that by the original cost of 73. We're looking at 4.79%. So that's looking appetizing, and I get to continually own this asset, even if it depreciated. I still at least get a good yield. Now, obviously, you would rather buy lower, and hopefully it goes higher. But if that was the case, I would almost assume that this asset would be higher in price than it was, just because this yield would get more attractive. But then it depends again on market conditions and what else is available. But now it is so. Yeah, this looks better buying CHD with compared to this yield. But let's say the 5-year was yielding like 6%, then it's like, oh man. And again, that's a year, not just the final year. So that's one thing. So from a cash flow perspective, even though this is higher than this, I'm still making more money from the cash flow, or the interest, or the dividends, if you want to call it that. So there is that to consider. But again, at the end of the 5 years, I get to own a lot. I get to continually own it and get more dividends. Yeah, I guess I'm talking myself into this at this current rate. Why? It doesn't make... Bonds are good. They're great at this price. But for me, I think the ETF is looking solid when I compare it. So, yeah, I'm getting caught up in the 6-month time frame. One thing... Oh my gosh, yeah, we didn't even talk about this. We need to talk about the... Is that even worth it? So, like, you know, we're all at different stages in our lives and stuff, but there's always some time in our life where we're gonna buy, let's say, a car, a house, you know, a boat, I don't know, an airplane, I don't know, whatever you want to do. You need to have access to that capital, and you need to understand, or not understand, but you need to kind of predict how much money you will have at a given time frame, or in a certain time of your life. So let's say, I'm 26 right now. Let's say I want in 30. I want to buy a house, Well, if I have all my money in, and I'm going to have to pull out, let's say, I don't even know, let's pick a number. Let's say 100K, let's just pick a number. 100K, easy. If I am 30, I would hopefully have 100K I can pull out of assets, or investments. If I have all my money in an ETF, ignore taxes. If I pull it out of the ETF, I might pull it out at a bad time where does this make sense? So, part of buying the ETF in any stock is, again, we'll go back to this thing I'm through like 8 times, is it's gonna go like this, maybe go like this, you know, you don't know, it go like that, I don't know, like, it does anything. If I have to sell here because I need to buy the house, sell. If I gotta sell right there, that stinks, because it's like all the dividends I earned up to that point almost meant nothing because I'm pulling it out. Because again, I don't have to do this, but again, it's the timing of certain things, maybe it just makes sense. If I do that with the bonds, let's say, even if I get 4.5% or whatever, and I'm banking on the 5 years, I know in 5 years I will have my principal plus the interest with a very good amount of certainty. And that is very powerful. I don't... Again, in a perfect, great, sunshine and rainbows world, you know, this continues to appreciate your X percentage each year, but I think I just found in life things don't work out that way. That when I need, or when I will need to pull out money, or when I need to do a big purchase or something, it'll probably be when the market's all poop. And if I were to pull it out at that time, it would be very tragic and a financial mistake. Whereas again, if I just time the bonds to mature when I kind of need them, or I is it like the bond ladder, or cycle the bonds to mature at different times, it's a little bit smarter with the money, because you can kind when you need the money, but you're still able to gain a certain predictable interest. Obviously, now that I'm thinking about it, that's kind of why I'm doing almost two portfolios, or I'm mentally dividing certain portfolios, but I kind of forgot about that. So, or like, right now I have these two things in the same portfolio, but there should almost be a separate portfolio that's like portfolio over here. So we have like the cash flow portfolio, then we have like the small box portfolio, and then we have the speculative. But there should be some down here where it's safe, or like predict the yield. When I need this yield, need money, but want interest or something. Like, you got your speculative stuff, you got your things, you don't care if you lose money, but you're kind of, you want to have some fun, take some risks, maybe make some money. I got the cash flow portfolio where I want to make some reliable cash flow money from other businesses or just other investments. Again, debt, your high yield savings, or some ETF or other stocks. But then I have this down here where it's, okay, I'm gonna need some amount of money in the near future, and I would like to, maybe, let's say I want to try and plan for 100K, buy this, and maybe, this portfolio, I want it to be like 50, but I want with 99% certainty when I'm 30 that this portfolio can get me 50% of that with almost certainty, so I can pull money out of other places if I need to. But I want this to be absolutely certain that I can have access to that money. So how I treat that money is going to be a little bit different in where I'm going to put it to work. I think, to me, that makes sense. I don't know if my rambling and chicken scratch and everything was coherent to anybody else. But again, it's just my thoughts and rambles and stuff and things I've been thinking about, and it's kind of fun to just take a piece of paper and start hashing it out and painting a picture of words. But yeah, I think looking at this, yeah, the T-bills are nice. The half year, 5.5%. And I think I should continually put it in there, but also it's like, okay, well, this is yielding pretty high too. And I think the stock market can still take a dump and, get back to a little bit better valuation. This yield is not 100%. This will fluctuate as well, but with some sort of certainty, it'll be roughly, it's not going to get cut in half, or it could, but I think the probability is low. I think this yield, plus or minus, let's say 25%, even 50%, I think is fine. That's still very good for owning for a long period of time, with a little bit of appreciation potentially, and the dividend growth. But also, again, you're owning an asset, and I don't think 4.5 is as, again, I'm not trying to be greedy. It's a great yield, but I'm just saying for how young I am, I think it makes sense, or more sense, to focus more at this exact moment in time if I have money towards like an ETF or some other potential stocks that I think have the longevity, but not ignoring the bonds at the same time. The 30-year bonds are yielding 4.38%. That is nice, but like if those hit like 6%, I think the market would dump, and I think money would be rushing into that, because 6% is pretty crazy for 30 years, almost guaranteed. And I get there's inflation, but like, yeah, it's just, inflation's gonna kind of affect everything. You won't get the appreciation, but you'll get that certainty almost, though. But who knows, in like 30 years, who's gonna default on who's dead and everything, so I probably would never actually do a 30-year bond. That's so long. Maybe 10-year would be the max. I think 5 years would I feel most comfortable with. Unless if again 10 years we're yielding like 5-10%, or not 5%, almost 5% now. It's like 10%. It's like feel like you just gotta. I think I exhausted this topic for now. I think I convinced myself just to go to an ETF as long as they're at the certain, as long as these are in this situation. But I gotta remember, I gotta ensure that I don't go too deep into this stuff because I do have goals in the near future, monetary goals, and I would hate to be in a situation where I don't have access to that capital because of timing of the market that I have no control really over. But also, you know, you want the money to do something, so having it somewhere where it's still accessible, but having that yield is critical. I guess, yeah. I kind of mentioned bonds in my safe portfolio, but also the cash flow portfolio. And I just wanted to make, I guess, the distinction that it's kind of the same thing, but it's just the money that you're going into bonds is a specific, or high yield savings is a more specific purpose, where if it goes into an ETF, I'm not expecting to take that money out, or I need that money in the somewhat near future. I mean, if I do, great. Like, if I find it when I'm 30, all of a sudden, you know, I got the 50% that I've been wanting, but I need to pull more, and we're at a pretty high level where the market is like just running up and up. Okay, maybe I'll take some off the table, right? I just don't want to be caught in that depreciation phase. Anyway, though, I think that's enough rambling and chatting, but hopefully you found it relaxing or maybe somewhat informative. But again, I don't really, and not that I don't know what I'm talking about, but I just read the same things everybody else reads, and I try to, you know, look at the market and ask myself the harder questions and dive a little deeper to see, like, you know, what should I be doing with my money? Because I think it's fun, I think it's important, and it's also nice to kind of chat about it. So anyway, though, hope you enjoyed the video. Thank you for watching. Hopefully you get some good rest. If you're not tired yet, go check out some other videos on the channel. But if you're tired, get some rest. I'll see you later. Take care.